The pitch is simple. Buy houses, collect rent, let tenants pay off your mortgages, retire early. The mechanics are real, but most people who try this end up working harder than their day job for less money, buried under debt they can barely service. The landlords who actually get rich aren't the ones who bought the most properties. They're the ones who ran the numbers before they bought anything. Part 1. What it costs to get in. Take a single-family home in a mid-tier market like Columbus or Kansas City, priced around $200,000. A 20 to 25% down payment means $40,000 to $50,000 in cash. Add closing costs 2 to 5% or $5,000 to $10,000 and a minimum $5,000 reserve for the inevitable first repair. All-in entry cost before collecting $1 of rent, $50,000 to $65,000. Building an actual portfolio, most investors target 5 to 10 units before seeing real income, means $250,000 to $325,000 in cash for 5 properties at conventional financing. Some use the BRRRR method: buy, rehab, rent, refinance, repeat, pulling cash out via refinancing to fund the next deal. It works, but it demands construction know-how, contractor relationships, and a cooperative lender. It isn't passive. Cross 5 units in one building and banks shift you to commercial terms, higher rates, shorter terms, personal guarantees. How the money actually flows. Collect rent, pay the mortgage and expenses, keep the difference. Simple in theory, thin in practice. On that $200,000 Columbus house renting at $1,600 per month, $19,200 per year gross. A $155,000 loan at 7.5% costs about $1,085 per month, or $13,020 per year. That leaves $6,180 before any other expense. Then, property taxes, $2, $400/year, insurance, $1, $500, maintenance at roughly 1% of value, $2,000, and a 5% vacancy allowance, $960. Total expenses, $6,860. Net annual cash flow, negative $680. You're paying to own it. But that number is incomplete. Your tenant is paying down principal, about $115 per month in year 1, growing to $250 by year 10. Appreciation in Columbus has run around 4% annually, adding roughly $8,000 per year in paper wealth on this property. Depreciation also lets you deduct the building's value over 27.5 years, about $5,800 per year in paper losses that can offset other income. So the real return is cash flow plus equity paydown plus appreciation plus tax benefits, what investors call total return. The catch: appreciation and depreciation don't cover a bad month. Cash is cash. That's why serious investors work backward from a target cash flow number and only buy deals that hit it, commonly the 1% rule, where monthly rent should equal at least 1% of the purchase price. Few markets hit that at full retail price, which pushes experienced investors toward off-market deals or overlooked markets. Part 2. The hidden costs nobody warns you about. Turnover. Every vacated unit costs 1 to 2 months of lost rent plus cleaning, painting, and advertising, $2,000 to $5,000 per turnover. Eviction. 30 to 60 days and $500 to $1,500 in a fast state like Texas. 6 months to a year in slower states like New York or California. One bad eviction can wipe out a year of profit on a small portfolio. CapEx. The big-ticket items maintenance budgets don't cover: a roof, $8,000 to $15,000, HVAC, $5,000 to $10,000, water heater, $1,200, or a full kitchen/bath remodel, $10,000 to $25,000. Maintenance is oil changes, CapEx is a new engine, and you need reserves for both. Insurance gaps. Standard landlord policies often exclude floods and cap mold remediation. One bad event can cost $20,000 to $50,000 out of pocket. Property management fees. 8 to 12% of rent if you hire out, up to roughly $23,000 per year across 10 properties. Interest rate risk. Portfolios built on 3 to 4% debt between 2010 to 2021 got hammered when rates hit 7 to 8% by 2023 to 2024. Some investors went cash flow negative overnight. Part 3. Who's actually done this? At the large-scale end, one well-known multifamily investor pivoted from single-family homes to apartment complexes, eventually overseeing a portfolio of thousands of units worth billions by raising capital through private syndications and taking management and profit share fees. The logic: scale kills the BRRRR math problem. A 300-unit complex has full-time maintenance and professional management, while a single house has you calling a plumber at midnight. At the smaller end, a well-known real estate podcast figure started with a duplex in his mid-20s while working a regular job, then scaled into a small multifamily portfolio through house hacking, living in one unit while renting the others, which qualifies for lower owner-occupied financing rates. He also targeted overlooked mid-sized markets where rent-to-price ratios actually cleared the 1% rule. The common thread in both stories: neither succeeded by buying what everyone else was buying in the hottest market. They found an edge and scaled only once the unit economics worked. Part 4. How people actually lose everything. The most common failure isn't a bad tenant or a market crash, it's overleverage combined with negative cash flow and no reserves. An investor buys several properties in a hot, expensive market where cash flow is already thin, banking on appreciation to cover the gap, and puts minimum down payments on each deal to preserve cash. Then a major repair hits, or a tenant stops paying, or rates rise and refinancing gets ugly. Suddenly they're short thousands a month with empty reserves, covering mortgages from personal savings, then credit cards, then losing a property to foreclosure, which can trigger guarantee clauses on the rest. This happened broadly in 2008 and again to a smaller group in 2023 to 2024. Survivors had two things in common: enough reserves to outlast the disruption, and deals that cash flowed from day one. The rule: never buy a property that needs appreciation to justify the purchase. Appreciation is a bonus. Cash flow is the business. Part 5. 2 real-world scenarios. Scenario 1. Small operator, 5 houses. Total portfolio value, $1 million. Cash invested, $250,000. Combined gross rent, $90,000 per year. Combined mortgage payments, $65,100 per year. Combined expenses, $35,000 per year. Net cash flow, negative $10,100 per year, or about $840 per month. But tenants pay down roughly $7,000 per year in principal across the loans, and at 4% appreciation, the portfolio gains about $40,000 per year in paper value. By year 10, the properties are worth roughly $1.48 million against $640,000 in remaining debt, equity of $840,000, up from a $250,000 start. That's about a 3.4x return, or roughly 13% annualized, despite negative cash flow. And as rents rise with inflation while the mortgage stays fixed, a break-even property often turns $300 to $400 per month positive by year 8. Scenario 2. Serious operator, 20 units. Starting from one house-hacked duplex and scaling over a decade into a 20-unit, B-class multifamily portfolio. Acquisition cost, $2.4 million. Cash invested over 10 years, including recycled refinance equity $600,000. Gross rent, $264,000 per year. Property management, 10% $26,400 per year. Operating expenses or reserves, 40% of gross $105,600 per year. Debt service, $115,000 per year. Net cash flow, $17,000 per year, or about $1,400 per month. Modest, but real. Add roughly $20,000 per year in tenant-paid principal reduction and $96,000 per year in appreciation, and total annual wealth building runs around $133,000. By year 15, the portfolio is worth roughly $4.3 million against $1.5 million in debt, $2.8 million in equity from a $600,000 start, or about a 4.7x return. Roughly 11% annualized, plus ongoing cash flow. Past roughly 50 to 100 units, the economics flip. In-house maintenance staff becomes cheaper than outside contractors, turning management from an expense into an advantage. Which is exactly why the large-scale investor mentioned earlier targets 300-plus unit complexes. One overlooked lever: short-term rentals. A house renting for $1,500 per month long-term might pull $2,800 to $3,500 per month on a short-term platform in the right market, nearly double the revenue. The trade-off is intensity, cleaning between every guest, dynamic pricing, constant communication. Operators either hire a co-host, 20 to 25% of revenue, or automate heavily with smart locks and contracted cleaning crews. Some public short-term rental operators have built 10 to 15 unit portfolios generating $40,000 to $60,000 per month in gross revenue, netting 2 to 3 times what the same units would earn long-term. The risk: cities worldwide have moved to restrict or ban short-term rentals in residential zones, and a single regulation change can cut revenue in half overnight. Rental property empires are real, and thousands of people have built them. But the path takes 5 to 10 years of active management, reinvesting cash flow, surviving at least one bad tenant or bad market, and staying disciplined while others panic or get greedy. The small operator isn't getting rich on cash flow at today's rates. They're building wealth through equity and appreciation. The serious 20-unit operator is running a real business with modest income now and serious wealth in 10 to 15 years. And the people who actually retired on rental income mostly built their portfolios before 2020, in cheap markets, at rates that no longer exist. That doesn't mean it's impossible now, it means you have to be smarter and more selective than they had to be. Passive income from property is real. It just comes with a price tag most people never read before signing.